Hello, and welcome back to the Fintech Takes podcast. Today is a great episode. As you might be aware, there's been some drama in open banking land. JP Morgan Chase has rolled out some fairly aggressive proposed pricing to various data aggregators and have really shaken the snow globe in the open banking space. So I wanted to dig into that in conversations. And there was truly no one better to do that with, no one in the world better to do that with than one of the folks who broke the news last week, Evan Weinberger, correspondent at Bloomberg Law, bank nerd friend of mine who's been on the podcast before. Evan and his colleague Paige Smith broke the news about JP Morgan Chase introducing this pricing. He was the perfect person to have come on. We talked about where this came from, what Chase's motivations behind it might be, both the sort of natural anti-competitive motivations, as well as the more sort of operational considerations around costs and risk management. We talk about the fact that it seemed to take even the CFPB a little bit by surprise, what that means, what's next. And then, of course, because Evan was on and he is an expert on all things bank regulation, I couldn't resist the opportunity to hop around a few other topics. So we talked about medical debt in credit reports. We talked about fair lending and disparate impact. We talked about CDFIs. We talked about the CFPB's bizarre decision to set aside the enforcement action that they had against Navy Federal Credit Union. It was a jam-packed episode of bank regulatory nerd talk, stuff that is really going to affect everyone in the ecosystem. So I can't stress enough how fun this conversation was. It's always great to talk to Evan, and I can't wait for you to listen to it. So without further ado, here is Evan Weinberger. Evan Weinberger, welcome back to the podcast.
It's a pleasure to be back.
I am delighted to have you. We've worked our way through some technical difficulties. We're both on the same recording at the same time with good equipment, so I feel great about this. I wanted to have you back for a number of reasons, because you've been writing some great stuff on Bloomberg Law, covering a whole bunch of different areas in the regulatory sphere that I feel like we need to get updates on. The most pressing one, which is where we need to start, is a story that you and your colleague Paige Smith at Bloomberg broke last week. Congratulations on that, by the way, that JP Morgan Chase is going to be charging for access to their open banking APIs. Obviously, this is something that I guess we could sort of say we knew was coming, in the sense that banks have made it very clear that they feel like they should be able to charge for this data. Contrary to what was allowed under the final rule published by the CFPB last year. It was a central point in the arguments made in the lawsuit that the Bank Policy Institute filed against the CFPB. However, having said all of that, and having obviously acknowledged the reality that the CFPB today is very different than it was under the Biden administration, and in fact so different that they've gone to the court in the BPI lawsuit and essentially agreed with the Bank Policy Institute and have asked the court to vacate the rule. Despite all of that, Evan, I will say I was pretty surprised to read your report and to find out just how aggressive, I suppose you could say, Chase is being in this effort. So take us a little bit behind the curtain in terms of how you and Paige initially kind of broke this story and what your sort of initial takeaway was when you were reporting it.
So apparently this had been bubbling up on Twitter for a few days. And I will admit, I have left Twitter and I am loving it. But it does mean that every once in a while, something like this is bubbling up and it kind of like catches you by surprise. And then somebody with knowledge of the situation contacted us last Friday morning and said, I have some time sensitive information that you might want. And we just went from there. Checked in with people who would know, got a sense of what the fees are, checked in with Chase. And, you know, from the data aggregator fintech perspective, these fees are aggressive is one word. I heard people say this is going to kill the industry. This is going to kill open banking. It's possible that those might be a bit of an overreaction. I mean, we got a lot of pushback from Chase not about the fact that they're charging fees, because they have not in any way denied that, but on the significance of the fees. We have a story out. I have a story out today, which we can talk about a little bit later. But Chase is basically saying if the fintechs and the data aggregators, they refer to the data aggregators as middlemen, and I try to stay out of that little fight between them. If the data aggregators follow the rules and operate the way that they should, these fees are not going to be as big a deal as they're making them out to be.
Yeah, it's fascinating because based on your reporting, I sort of similarly dug into the story and talked to a bunch of people who'd be in a position to know. And I think you're characterizing it right? I mean, from Chase's perspective, they are positioning this as, look, we support this robust infrastructure to enable this activity to happen. That infrastructure is not free. It's not cheap to stand up. A lot of the use cases that we enable through the sharing of this data come with risks for our customers, for the bank, and we need to be able to price against all of that. I also will say in Chase's public statements that they've made now that this news has broke, they sort of vacillate between talking about this as a cost recovery mechanism, but they also then will sometimes use the word value, like value capture, like we need to be compensated for the value that is being provided here. So, Evan, I kind of get the sense that it's a little bit of both, in that it obviously rankles the banks to have to provide data for free when there's a cost to them to provide these APIs. And that seems very logical. But they also do talk about value. And we've heard Jamie Dimon and other executives over the years sort of bemoan the fact that an entire category of companies exist that make money off of data that is being provided to them for free, and that maybe the value exchange there should be sort of rebalanced. So to what extent, based on your understanding of the pricing that was shared, and obviously this is just like the opening stage of the negotiation, so we'll see sort of where things land. I guess I'm curious, to what degree do you think this is about kind of cost recovery and risk mitigation versus like we want a piece of the pie, or even like the more extreme fintech interpretation, which is we don't want this pie to exist at all, and we just sort of want to reset the fintech ecosystem to kind of be what it was, 10, 15 years ago?
Yeah, I mean, I think that there's, I don't know if I could put percentages on all of those things because I'm not in their heads, but there's definitely there is a cost portion of this, and that's real. I mean, it does cost money to set up an API. It does cost money, for these things to keep operating. I mean, Chase says that they get 2 billion pings, calls a month on the data. Their argument is that maybe around 90% of that is not even necessarily consumer requests to do so. I mean, a lot of that is probably budgeting apps, things like that have to keep a constant eye on an account. So they have to come in, periodically and just say, all right, you're getting dangerously close, so you're going to get an overdraft fee at some point. So there is a cost there. That's not fake on Chase's part. And I sort of see their argument of, hey, aggregators, fintechs, you can't do what you do without us. So how about a little, to quote Caddyshack, how about a little something for the effort here? And I mean, there might be, you've seen, particularly in the last couple of days, some big crypto investors have started talking about, like, they're creating a walled garden. They want to stop us from getting access, and they want to keep dominating the financial services space. I couldn't tell you exactly how much of that is in there. I would say there's definitely not 0% of that, but I wouldn't want to say that that's the whole driving force here.
Yeah, I think that's well said, because there's truth on all sides to this, right? Like, there are risks, there are costs, there are legitimate competitive concerns, right? And so this is sort of like bundling all those things together. A couple other things, and you referenced this in your story, and I want to ask you about this, is there also seems to be some distinguishing between use cases, right? So one of the main sort of splits in the pricing, I think, that's been shared is that payments-oriented use cases of open banking are more expensive under this proposed pricing than non-payments use cases, right? So if you want to pull the data for budgeting purposes, or to monitor someone's account for earned wage access, or to do cash flow underwriting, that's one price. And then if you want to access what the industry calls tokenized account numbers, TANs, which is really just a secure way of sharing a routing number and account number to facilitate payments, that is a different, higher expense. And that one is, I think, maybe a really interesting test case for this question of what's the mix of intents behind this pricing? Because, again, you could kind of see it from different perspectives, right? One perspective is that, as you were just laying out, a lot of the volume that hits these APIs actually comes from budgeting apps and from earned wage access and from some non-payments use cases, right? I would say just solely from an infrastructure perspective, payments use cases are actually one of the lightest touch ones, because you're just getting the tokenized account number. You might only get the tokenized account number once and then use it as long as that TAN is still active and hasn't been revoked. So it's actually a fairly light touch use case from an infrastructure perspective compared to some other ones. However, on the other hand, you could also say, well, payments comes with a lot more risks, right? Because if there's an initiation of a payment and then the consumer ends up getting scammed or they're unhappy in some way, that might result in more customer service calls coming back to the bank. It might result in some compliance costs if they try to file a dispute or anything along those lines. So there are potentially kind of more all-in costs to payments than there are other ones. And then I also think it's fair to say Chase has expressed some significant, I would say, competitive concerns about pay by bank being sort of a threat to their legacy payments businesses. And you could also see the competitive concerns they would have in enabling payments use cases specifically. So what was your reporting telling you on this split between different use cases?
Yeah, I think that's a lot of it. There, as we've seen with Zelle and all the fights over Zelle, that's a direct payment, run by the banks. And the banks are catching a lot of heat for fraud on the Zelle platform. And it's not, and it's fraud that's being done by third parties. It's not like, it's not like the banks are necessarily, involved in committing anything, but they're, the complaint from the Elizabeth Warrens of the world is that they're not doing it, and the former CFPB, they're not doing enough to prevent the fraud. So there's the risk there. There's the reputational risk. If you're allowing, these payments, if you're not stopping, fraudulent payments on any of these platforms, you're going to catch heat if you're the bank, right? There's also, you didn't mention the interchange part of this, but there's always going to be that. Like you mentioned, pay by bank. That's something that people have mentioned to me. Yes, pay by bank is potentially a threat because it takes away debit card payments, which takes away interchange payments. So there's that competitive part of it where that's not an insignificant amount of their business is interchange fees. I don't know how much of that goes into the equation here, but it's definitely got to be part of it.
Yeah, I think so too. And I think some stuff is still to be seen with a lot of this, right? I mean, this is I've heard it described by folks who are sort of involved like this is the opening in a long negotiation and set of discussions, right? And so you could sort of see one way of thinking about that, which is like, look, whatever price you're willing to settle on, if you're a good negotiator, you go in and set the price way higher than that with the expectation that it's going to come down. So on the one hand, you could sort of go, well, maybe this is just like, hey, we're going to start high, but we're totally willing to meet in the middle. I maybe am a tiny bit suspicious of that analogy, just in the sense that like, if you go into a car dealership and you're like, hey, I want to buy a BMW, you might go in with a plan to like, ask for something under sticker price by a pretty aggressive amount. You're not going to ask for it for $1 though. Like there's a limit to how aggressive you're going to be in negotiations if you're trying to negotiate in good faith. And I have heard it described, and you guys did reporting on this about how much more this pricing would be than what the aggregators charge their in fintech companies. Like that reported difference is quite significant. And so it might indicate that the pricing is even a little bit beyond that. But when we think about the future and kind of where this goes, I mean, a couple questions I have. One is, are the companies negotiating right now over this? And then the second question I have is, are those negotiations all starting from the same place? Because obviously there are multiple aggregators. There's obviously the ones that get talked about a lot that are sort of in the fintech ecosystem, like a Plaid or an MX. There's ones that are owned by the card networks. Visa owns Tink. MasterCard owns Finicity. There's one that's owned by a consortium of big banks, including Chase, Sequoia. So do you have a sense of, A, like where they are in this like process of negotiating, and B, if all the negotiations are sort of starting from the same pricing, or if there are different conversations happening?
They're not all starting at the same time frame, because it's there is a provision, as I understand it, there's a provision in the Chase contracts that's also different than the other banks have with these data aggregators, that allows Chase to have a 60-day notice to start charging fees. Because right now they're not. The contract says that there is no fee for it, and different institutions got different companies got notices at different times. They were all sort of in the late June, early July period. They're all supposed to start taking effect sort of late August, early September. We said sort of generally early fall kind of area, depending. There are negotiations ongoing, and then, I've spoken to folks on bank side, and they've been like, we don't understand why people are angry about this, because we've been having negotiations. The aggregator side that has a different view of how those negotiations are going. They're sort of, in the sort of, the way that I've heard it described from the bank side is this is an amicable negotiation, nothing out of the ordinary, and we'll make something work. What I've heard from the fintech side is, I have altered the deal, pray I don't alter it any further kind of negotiation. The truth is, as always, somewhere probably in between those two poles. I wouldn't say that, I wouldn't say that there's, the indication is that it's one way or the other. It's, everybody's talking their book to a certain extent, right? So you take it that way. But who's like, I'm not sure that, I think that everybody's getting different pricing quotes. I think that people are, the timing's a little bit different. It's all sort of in the same ballpark, though, is my understanding.
Got it. Well, first, Evan, there's no quicker way to my heart than quoting Empire Strikes Back. So well done, sir. No, I mean, I think that's right. And I guess to put a capper on this, because I do have a couple other areas I want to talk about. But before I let you move off of open banking, which is the drama right now in fintech. So it's definitely dominating a lot of the discussion. I did want to ask, and you guys at Bloomberg have done some great reporting on this. You referenced a story that was just published very recently that I want to ask you about. First, do you get the sense other banks are going to follow Chase's lead here?
Nobody has said it directly. Bill Damchak, the CEO of PNC Bank, who until relatively recently was involved in a pretty significant legal fight with Plaid over data access. He said on his earnings call earlier this week, we applaud what Chase is doing. We are considering it. And if somebody's going to say that on an earnings call to investors and analysts, that's probably pretty far down the road. I think there were some unique parts of Chase that allowed them to go first. One, obviously, the sheer size. And two, there were some contractual things that are different there that allowed them to move forward. But, if one bank says we're going to do this, I mean, if you're another bank, can you really not? I'm not sure about that.
Well, no, I think you're right. And it does seem like there's this element of kind of waiting for a second, right? Like this is, not to turn the analogy terribly dark, but this is a little bit like all the penguins crowding up to the cliff and then shoving one penguin off to see if there's any seals down there. Banks are very well known for we'd like to go second, we wouldn't like to go first, but you can be sure everyone is watching the reaction to this, both from a policymaker and a legislator perspective, as well as from a public perception consumer perspective. And speaking of the regulatory perspective on this, you guys, I think, just did some recent reporting on, how regulators might be responding to this. What have you found?
Well, let's sort of set the stage here. So
Sure.
you mentioned in the intro, the CFPB under the Biden administration, under Director Chopra, put out this their open banking rule last October. BPI sued, Bank Policy Institute sued that same day. The rule itself, though, I mean, it's rare that you got Republicans in Congress to say this rule is actually okay. I don't think anybody loved it. I think everybody on all sides of industry had things they don't like, as you can see from BPI suing and from what Chase is doing now. The fintechs had things that they didn't necessarily love, but they kind of said, we can live with this. When the Trump administration took over, that changed. The CFPB went to court and said, we are no longer defending this rule. We would like you, court, to vacate it. Originally, people had thought, well, maybe this will survive because there was some Republican support. They could kick it back. They could tweak it. They could make a few changes here and there, but maybe it'll survive. That didn't obviously happen. What we reported today is that that was a really rushed process. A lot of things that are happening at the CFPB is a really rushed process right now. What we reported today is that at least one political appointee, probably some others, maybe even at other agencies, have started to say, we were not anticipating fees of this magnitude. And we might need to take a look at this. That being said, the CFPB is in the process of firing most of its staff, potentially all of its staff. There's not really that many people there doing work, especially on the enforcement and investigative teams that would be looking into this sort of thing. So I don't know. I think that's much more of a case of people at the CFPB, not one hand at the CFPB, not knowing what the other hand is doing, more than, oh, maybe they'll go and change things. I'm not anticipating that the CFPB is going to come in and say, sorry, we're taking that back to the judge in Eastern Kentucky. It is interesting, though, that, as I mentioned before, crypto is starting to get involved in this. And as everybody knows, the crypto industry, particularly Andreessen Horowitz, has the ear of the Trump administration. And a prominent person at Andreessen Horowitz has said has called this Operation Choke Point 3.0. There's that. I've heard that merchants aren't necessarily happy about this. Merchants are kind of intrigued by pay by bank. And if this is a way to at least slow down pay by bank, that's something they might not necessarily like.
No, it's very true, right? I mean, I just watched one of the newer Godzilla movies with my son, who loves monster movies. And the one we watched is the one where Godzilla teams up with a bunch of other monsters to fight an even bigger monster. And this reminds me a little bit of that, where it's like, hey, crypto industry, hey, large merchants, like, let's all get on the same page. And then like Chase is the like gigantic kaiju on the other side that they're all trying to like bring down. So I do think from a lobbying perspective, a lot of that sort of strange bedfellow dynamic is probably going to form around this, because this is one of those areas that does tie together pretty disparate parts of the ecosystem. And I think that's probably true. Just to add one thought on the CFPB point, and then we'll jump to another story. It does seem a lot like moment to moment, there is just no coherence about what the CFPB is doing, right? Another thing I've heard that I think is kind of interesting about this is, well, we might still like draft up a new rule. Like if the rule gets vacated, like we'll write a new version of the rule. And to your point, like there's not a lot of staff left. Writing a rule, if you're going to follow the kind of traditional APA process, is both resource intensive and time intensive. And it also kind of cuts against the core legal argument that BPI made in the case, and that the CFPB has come out and said they agree with, which is that the original statute doesn't even really allow for third parties to access this data in a programmatic way. It's supposed to just be the consumer personally can get access to take their data with them if they want to go somewhere else. So it does seem like every time I look up and kind of monitor what the CFPB is doing, they're always sort of surprised, or one part is like, oh, we didn't expect this, or oh, now we're going to do this. And so there does seem to be a certain amount of lurching around, which is not, based on the reporting you guys have done, shocking, because there's not a lot of people there. the people who are kind of running the ship seem to be doing so in a somewhat closed door fashion where there's not a lot of coordination. And I mean, I could even see this becoming an issue between different parts of the administration, some of which might be a little more like, no, we like fintech, we like crypto, like we want this stuff to continue. Any last words on sort of like that jumble of like different motivations?
Well, I mean, this rule is part of Dodd-Frank, so it's been there. The CFPB was supposed to write it, as early as 2011 when it opened its doors. Yeah. They obviously had mortgage issues that they needed to take care of first. There were some other pressing things, but then this thing just is really hard. There are so many interests that you need to balance. During the Obama administration, there was talk of doing it. It didn't happen. During the first Trump administration, they began the process. And in fact, the first Trump administration was like, no, actually, the way that you should read the law is that you can authorize third parties. A consumer can authorize a third party to come in and act as their agent. That's the way that the law is read. The current Trump administration has decided this is not the way to do things. So I look at it and go, I don't think, for an agency that is eliminating people and who just saw Congress cut its budget significantly, they have set up for themselves an extremely aggressive and ambitious rulemaking agenda just by doing this. But there are other things that they want to do. And I don't know how they're going to do it. Like they started the year with, I want to say, somewhere between 1,500 and 1,700 people. They're down to under 1,400. The CFPB seems to want to get under 200 people. And they have stuff that they're like legally required to do, like examinations and like an Office of Service Member Affairs and student loan work, all sorts of stuff that they are required to do. And they want to do this rulemaking, and they have no money to do it. And they're going to have 200 people or something like that working at the agency. I don't know. Like, I'm skeptical, even if their heart is in the right place and they want to redo a rule. I don't know how they're going to do it.
Yeah, that's exactly how I feel too. It just seems like one of those spur of the moment decisions that has a bunch of downstream consequences where you're like, oh, I'm sure we'll figure that out. And it's like, well, how will you figure it out? So I completely agree with you. Let's talk about a few other areas that the CFPB and other agencies have been digging into, because it's not just open banking. There's changes happening everywhere. One of the ones I wanted to ask you about that is relevant actually to this one, because it involves the vacating of a rule written by the CFPB, is medical debt on credit reports. So obviously under the Biden administration, the CFPB made a very aggressive move towards just eliminating the reporting of medical debt to the credit bureaus. This is seen, I think, from a consumer protection standpoint as sort of a fundamentally unfair feature of the credit reporting ecosystem. And the argument goes something along the lines of, healthcare is really expensive. It continues to get more and more expensive. It requires consumers to take on debt. A lot of times the debt they take on is due to emergency medical accidents or other things that happen where, you get in a car accident, you're not thinking about your credit report when you go to the hospital and you go to the emergency room, but you end up with massive bills on the back end. This is sort of fundamentally unfair to exist in credit reports. We should just get rid of it entirely. You also hear more sort of nuanced arguments around like, a lot of the data is not reported well. There are errors. Medical bill collectors will use very aggressive tactics to try to get consumers to pay back. They won't always report positive repayment data, only negative data. So there's a lot of like kind of more nuanced critiques under the surface. The CFPB under the Biden administration took sort of a just very broad approach to say like, this just does not belong in credit reports writ large. As you reported at Bloomberg, though, that rule has been officially vacated by a court at the suggestion of the CFPB, similar to how they're trying to approach open banking. What's, I guess, kind of the motivation on the part of the industry in pushing back against this rule? And do you think like we're just going right back to where we were before, or there'll be any other changes here?
So it gets really complicated, as with a lot of this stuff. But the reasoning, when I've spoken to the credit reporting industry, their argument is a couplefold. One is that if you are going to get a mortgage, even if you had an unexpected giant debt due to a health issue, you still have to pay it back. And it's still there. So it makes it is something that affects your ability to repay your mortgage, to repay your car loan, that sort of thing. Their other point is, the problem isn't necessarily credit reporting. It's that the medical billing system stinks, and you can't get at that through this kind of rule. Their third argument is that to be fair to the credit reporting industry, they have made a lot of changes to the way, the big three at least, have made a lot of changes to the way that they handle credit reports. Things like, smaller, debts under like $500 that those are gone. There are a bunch of other changes that, have some real impact. So there are those arguments, and, especially on medical billing. See exactly where they're coming from. They're saying you're trying to get at this massive problem that has been, because of the way our healthcare system is done. That's not really something that you can address by going through us. There is some truth to that. The problem that the industry has is that several states have put this into law as well. Colorado, New York, Maryland just did it this year. So I've heard that what my understanding is that they're going to try to go state by state and wage this kind of legal fight. I mean, I don't think the CFPB is going to do anything about this. Congress was moving to repeal the rule. They missed. It didn't happen. They were going to use what's called the Congressional Review Act, which only requires a majority vote, a simple majority vote in both houses of Congress and the president's signature to repeal a rule within a certain time frame before it kind of that look back period expires. It didn't happen. There were measures that were filed in both houses. It's not. As we've seen recently, I don't think that members of Congress care that much about whether a vote is technically easy or hard. If the president seems to do it, they'll do it. At least Republican members, but for whatever reason, it never came up. The CFPB said, "Court, you should vacate it." Some consumer groups tried to defend it, didn't work. It was vacated. So we'll see. But I wouldn't anticipate anything else on this.
Yeah, the state part is really interesting, right? Because I think that the credit bureaus just sort of fall into this very strange gray area a lot of times with these things where it's like, yes, they are overseen at a federal level by the CFPB. They are also subject to state by state regulations. And, we've seen this in other areas, right? Earned wage access, BNPL, like these fights oftentimes will happen kind of somewhat symbiotically between a state level and a federal level where, you'll work on sort of advancing your case. In one state, you'll get sort of a foothold and then you'll try to move it forward. And then maybe at a federal level, you'll either get sort of support or maybe something will get pulled back. So it seems like right now, the states, to your point, are still trying to sort of make this argument. I will admit, I'm a tiny bit surprised at how aggressive the industry has been in trying to turn this back. And I do think, because it's kind of one of those notions that's like unpopular to defend, even though to your point, there are a lot of good reasons for it, right? Because I tend to personally agree that, these debts factor into your ability to make payments, right? Setting like willingness and responsibility and all those other questions aside, like just from a cash flow perspective, it's really important to know about these things. I'll also say that a lot of the kind of conversations around what the credit bureaus can and can't do or what data they have access to sort of stop making as much sense when you start to think about cash flow data coming from open banking and being another way to get insights into this. Like, oh, this isn't in the credit bureaus. Well, no problem. We'll just get access to the consumer's bank account. Now, of course, our first story in this podcast is maybe you won't have the inexpensive access to bank transaction data that you thought you were going to have. But I do think there are multiple ways to address this problem. Just, in the interest of trying to think about how this might kind of play itself out more. It sounds like from your perspective, you'd be watching the states more and kind of not as much at a federal level. Is that fair?
I think that's right. I mean, I think in general, for any consumer protection efforts, you should be looking at the states, not at the federal government right now.
Yeah, that's well said. I would totally agree with that. Flipping it around to the other side, and we talk about things that are maybe unifying forces across the federal government when it comes to financial services regulation. The acronym DEI is obviously, I think, one of the things that sort of strings together a lot of different priorities across this administration. And in financial services, one of the areas where I think we're starting to see kind of a unified push across agencies is around fair lending. And you've done some reporting on this. Can you just give us the update on what's going on with fair lending, maybe a little bit of a primer for folks who don't know on what disparate impact is? Because I'd like to unpack what's happening here as well.
Right. So maybe we'll start off with what disparate impact is, and then we can jump into what's going on. So disparate impact is basically using statistical analysis to determine lending patterns and see if there's, there was a recent case involving Armenian Citibank not lending to Armenians in Los Angeles. You can use disparate impact data to determine lending patterns down to there, and the Biden administration, basically administrations going back for a long time have been using it. The Supreme Court in a decision, I believe it was in 2015, it's called the Inclusive Communities decision out of Texas. They said, the Supreme Court said no, disparate impact is a valid way to measure for discrimination and to conduct fair lending exams. So it's something that the Biden administration used a lot, the Obama administration used a lot. Even the Trump administration used it to a certain extent. It was used to a certain extent in the Townstone case that was brought by the first Trump administration, which we can get into later. It's a weird CFPB thing. It makes my head hurt. So Donald Trump in April signed an executive order calling on all federal agencies to stop using disparate impact, not just the banking regulators, the Department of Justice, which brings redlining cases using disparate impact, any other education department, whatever, you name it, if they use disparate impact, you're not supposed to use it. So it was not really a surprise when the OCC, I started hearing from people that the OCC had officially sent out a notice to its examiners saying, stop using disparate impact. This was sort of late June time period. And then this week, they officially took that out of their exam manual. So they're not using it. So what an examiner has to do is prove either intentional discrimination, which is really hard because you need to get access to emails and phone calls and all sorts of things, or sort of disparate, not disparate impact, but sort of
like treatment, right?
Treatment. You're treating. Thank you for refilling the word. You're treating different communities differently. Again, much more difficult than using statistics, and it's only a matter of time before the other agencies do this. It is an executive order. The FDIC hasn't done it yet. The Federal Reserve hasn't done it yet. It will not shock me when they do. I mean, executive order, an independent regulator doesn't necessarily have to follow an executive order. It's not law. People write about them and treat them as if they are law, and they are not. They are long tweets, basically. But they have an effect, and if the president has appointed you, you will most likely follow it.
Yeah, I mean, so a couple of things on this one, because I'm actually really fascinated by this. Obviously, this is all a directive coming from the top, as you said, with the executive order. It does seem like when these things start as an executive order, you tend to see more coordination across, right? Like my read of the Trump administration, second Trump administration, is that in general, there's like lots of little fiefdoms with different priorities that are kind of coming from different places. But occasionally you see these things that sort of cut across. And this is one of those ones, right? Where we are trying to move away from disparate impact, which, as you said, is a very well-tested legal theory about how to approach fair lending and detecting discrimination. Just to add like one kind of point of clarification on disparate impact, as you said, it's looking at the results of lending, right? So it's something where you look sort of retroactively at, okay, a bank made these lending decisions. Is there disparate treatment, essentially, or disparate impact on different protected classes under fair lending laws, right? So does this group that we can define from a racial perspective or gender, or I should say sex, actually, national origin, there's a whole bunch of protected classes under Reg B, under fair lending laws. And if there is a disparate impact on a specific group, that can be the beginning of a process of you identifying, hey, there's a problem here. The other thing that's interesting to me about disparate impact is there's kind of like, again, it's the beginning of a process where the lender works with the regulatory agency on the problem, right? So like the regulator, my understanding is the regulator then goes to the lender and says, hey, there seems to be some disparate impact here. There can be a search for what they call less discriminatory alternatives, right? So like, is there a different way that you can tweak your model that can have the same relative predictive power, but won't have this disparate impact on this group, right? So it's this very sort of subtle, and I would argue, very helpful way, kind of collaborative way for lenders to screen out what I think the law was intended to catch, which is like this unintentional form of systemic discrimination where it's like, hey, this is hurting this group. You might not even have been aware of it, right? Especially in the age of like building more algorithmically driven models for understanding credit risk and evaluating credit risk. You guys just might not have been thinking this has this impact on this group. Is there a way we can go back and tweak this model so that you can get roughly the same performance you're getting, but it doesn't have this disparate impact on this group? Now, obviously, as you referenced with some of those cases, it doesn't always end up in sort of a conciliatory fashion like that. Sometimes it does end up in enforcement actions, lawsuits being brought. But in general, I guess the point I'm trying to make is it does seem like a tool that's a pretty useful tool in the toolbox for regulators and even potentially in some cases for lenders. In the absence of having that, do you have a sense of like how lenders are thinking about approaching any questions around fair lending? I mean, I don't think this is going to be like, oh, great, now we get to discriminate against a bunch of people. Like, I don't get the sense it's like, now it's the Wild West or anything, but how are lenders going to operate in the absence of this being in these handbooks?
Yeah, I mean, I think, first off, your description of it is right. Usually what happens is it's accidental. It's a problem with an algorithm. The bank examiner goes in, they talk about it. We never hear about it in the public. We wouldn't know because they figure it out. In that way, it's a very useful tool. There are many, many steps before you get to an enforcement action people hear about. From what I've heard, talking to lawyers who advise banks, they're all saying, hey, don't change what you're doing.
Right.
There is, for a number of reasons. One is there is still the ability for private groups, state attorneys general, state banking regulators to use this data and do their own reviews. Is it as effective as like a bank examiner? Probably not, but it's still there. There is a risk, and if they find something, it's not going to be a quiet resolution in the same way that it would be with a bank examiner. The other thing is that there's a long tail of statute of limitations on this. It's over 5 years. It's 5 years or more. But I think 5 is the number people work with mostly, depending on the law. So theoretically, 2028 or 2029, a Democrat takes office, the priorities are going to be a lot different. The regulators can go and look back and say, hey, we saw this back in 2022 or 2027. This looks like a problem. Let's have a talk about this. And you don't want to be caught, in that situation. So I think most of the people who work at banks believe in fair lending, and they don't want to get caught in these kind of situations. And caught might not be the word. They don't want to be, in these kinds of situations because they don't want to do that sort of thing. They don't want to, discriminate against specific groups. So they generally are just going to keep doing what they're doing. I don't anticipate a lot out of the Trump administration at all. I mean, one idea that I've been toying with is how, if your administration's policy is to get rid of DEI, how you're probably not going to be that careful about fair lending issues.
No, I think that's
politely.
No, I think that's totally fair. I mean, I get the same sense, and the caution on the part of lenders, I think, is right because there's potential legal risk still if you decide to do anything different, both at a state level, private litigants, the look back period being longer than the length of time that this administration is going to be here. So all of those are reasons why you wouldn't want to, on top of the more fundamental reason, which you also laid out really well, which is I just don't think most lenders are like, oh, great, now we get to discriminate against people and lend less, right? Like this is always my topic when I talk about anything financial inclusion related is like inclusion equals loaning more money to good borrowers to make more money as a bank. So generally speaking, everyone wants to lend more. And that's, again, why I think disparate impact is actually a useful tool in the toolbox is it's just a way of identifying, hey, you might be making a decision here that's actually bad business, right? And you might want to look at that. And so I think it does create an opening for those types of conversations. And in the absence of that, I hope maybe that lenders will continue to just kind of do roughly what they were doing privately and just with a little less scrutiny at a federal level, perhaps on that one area. Evan, I also want to ask you real quick about CDFIs. And I don't know that you've done as much reporting on this, but it's been reported broadly, and I just wanted to get your take on this. The Trump administration seems to be sort of, this might be a little too strong of language, but like at war with the concept of CDFIs in a way that I find truly bizarre because CDFIs, community development financial institutions, are this very specific form of bank, credit union, what have you, that receive some level of financial support from the government in order to lend into specific sort of underserved or low-income communities. It's for a long time been a pretty non-controversial bipartisan type of initiative, right? And what's been happening recently, according to reporting, American Banker had some great reporting on this recently, is that there's an effort underway to essentially not fund CDFIs to the same level that they have been funded at previously, even though sort of from a statutory perspective, CDFIs are still required to be funding. The Trump administration seems to be sort of trying to grind that funding to a halt and stop it from getting to CDFIs. The irony of this is that CDFIs are really concentrated in rural communities, a lot of rural communities in southern states, which tend to overlap quite a bit with sort of traditional Republican voting districts. Do you have a sense of, I guess, what's happening here, why it's happening, and like what it might mean for CDFIs? Because I'll be honest, every time I look at this particular story, I kind of come away scratching my head.
I don't know if I can give you a why.
Probably not. That's the theme of this episode, honestly.
Right. But I've done some reporting on this, and you're right, the American Banker stuff recently has been really, really good. So they are grinding it. There's also a provision to set up like a new sort of rural, almost exclusively rural fund for community financial institutions. Nobody knows how that's going to work. And, I've spoken to, CDFIs I'm in New York, in the New York area, and they're like, this is going to be a big problem for us because if you're only focusing on rural ones, there's a lot of people that we serve in the Lower East Side or in the South Bronx or in Chicago or whatever, where they need the money. So my sense is that there actually was a fight within the Trump administration. I mean, I think when it comes down, Treasury Secretary Scott Bessent has spoken positively about CDFIs. When it comes down to it, I think that a lot of this stuff comes down to what Russell Vought, the director of the OMB, the Office of Management and Budget, and also the acting CFPB director likes and what he does not like. And my sense is that he does not like a lot of stuff, including CDFI funds. So as it stands right now, it looks like when this started to come out earlier this year, senators from both parties sent letters saying, hey, we don't like this. We want to fund CDFIs. This is a really good program. And it, for bang for buck, it is a really effective program. The House Financial Services Committee, they also raised some concerns in the skinny budget that the Trump administration released, which is sort of like their outline of what they would like to see spending. They really hammered the CDFI fund. A lot of that is going to be for personnel. I mean, it's a tiny staff, but It is a staff, and it's the people who help new CDFIs come in and apply for grants, apply for different programs, things of that nature. They are really taking a hammer to programs that for like food security, which is really important. Other things like that. I guess the thinking is we don't want government messing with private markets, or it's woke to help people buy fresh fruit. I don't know. I couldn't tell you what the reasoning is, because either you don't get reasoning, or you get weird reasoning, or you get multiple reasoning, and the president, if he says anything, says something like outlandish and whatever. But I mean, I think the thing that I've heard is that for well-established, there's some really well-established CDFIs out there. Mm-hmm. They would be hurt, but they would be okay. They'd be able to continue doing their work, either through private money, through state money, that sort of thing. Where this is going to hurt the most is on like small community loan funds. New CDFIs will have a lot of trouble because what happens is once you get access to the federal money, you get seen as a reasonable risk by big banks that then give money to and foundations that'll say, well, if it's good enough for the federal government, we can give them money too, and then that's how you grow. That's going to be cut off here, is a lot of the fear that I've heard.
Yeah, I mean, just to add a point of emphasis to what you said, I mean, there are programs where the ROI is maybe a little unclear, and then there are programs where the ROI is pretty clear, and everything I've heard matches up with what you're describing, which is like, this is not a huge expense, and the ROI is terrific in terms of like stimulating lending and economic activity in these areas, right? I've spoken to folks who run CDFIs, and what they'll say is it's like, look, these are just like borrowers that like banks just don't have good access to or understanding of. And our whole mission is to try to understand them and to help get them into the system, right? I mean, this happens over the backdrop of, we've done a great job in this country, especially over the last like 10, 15 years, of really driving down the rate of like unbanked households in this country and bringing more people into the banking system. And, some of that is due to fintech companies and like more competition in the private markets. But a lot of it is also due to this recognition, I think, that like this country is really big. There are lots of little pockets that are sort of difficult or unprofitable or just challenging to reach into and serve well. And the CDFI model is a proven way to do that and to get these people into the system. And you even have like private companies like Netflix, like storing a portion of their deposits at CDFIs because they want to like, have this impact. And also like it's good business and it works. And like the mortgages that are being made to these first time home buyers are good mortgages and are actually like proving out relatively well. And I guess it touches back on fair lending and a couple other things where it's like, I'm fascinated by things that the current administration is doing where even like the lenders are going like, hey, we actually kind of like doing this and we would prefer to sort of not to keep doing this and not stop doing this. And it contrasts very strongly with other areas like open banking where there's clearly a fight with two sides. This one seems like, to your point, Russell vote versus everyone else to a degree.
Yeah, it'll be interesting to see when Congress gets through the budget process what they do with CDFIs. And then it will be interesting to see how much Russell vote and the Trump administration listen to Congress when that comes about, because they don't necessarily look at Congress as a co-equal branch of government that has a say in all of this stuff. And for reasons that I don't necessarily understand, Congress, goes along with that idea.
They do. So, Evan, before I let you go, one last thing I just want to get your super duper quick reaction on, because I think maybe it was the single thing that's happened recently since we last talked that I've been most surprised by. if I was to look across all of the like specific enforcement actions that have been brought under the CFPB before the second Trump administration took over, and I was to try to guess, like, all right, what's the one area where it's like the least likely that the Trump administration will try to sort of take back or stop or set aside an enforcement action that had been done under the previous administration? Like, what's the one that's going to be safe? I would have guessed that it would have been any enforcement action against a bank or lender or service provider that had negatively impacted military service members. And yet, I was not going to be proven correct in this prediction, because the CFPB essentially set aside an enforcement action against Navy Federal Credit Union. Can you just give me your super quick reaction to this? And I guess just the last question is, that was my last sort of like, I think this is the one consistent through line across what the CFPB was doing. Were you surprised by that? And like, do you think there is any through line that we can use to predict what's going to happen next?
Nothing surprises me. And don't forget, when the CFPB laid out, I guess it was in April, their new priorities, they said their priority is going to be military borrowers. So with this Navy Federal Credit Union, they did is they terminated the enforcement action, which means that, anything that wasn't done doesn't need to be done anymore. And there was about $80 million worth of overdraft fees that did not go back, that the old CFPB said were illegal, that have not gone back to the borrowers. Yeah, I mean, I don't know. Am I surprised? Is there a through line? The through line is that they want to just clear the decks of anything that Rohit Chopra did. And there are some banks that got hit with very similar enforcement actions to Navy Fed that are probably sitting there going like, hey, when do you cancel my enforcement action? When am I going to get something here? And that hasn't happened yet. I will not be surprised when it does happen. These things take time. They don't have a lot of people working there anymore.
Yeah, that's exactly it. They don't get in line because we don't process these fast, but you can certainly register your complaint.
Well, I know that banks, I don't know about banks, but I know that there are companies that have gone to the CFPB because a lawyer said, people have come to me to ask me to do this, and said, hey, would you like to take a second look at this enforcement action that we're working underneath right now?
Would you like to take a second look? That is a great place to leave it. Evan, thank you so much for hopping on. Really appreciate it as always. The reporting is terrific. And if anyone out there does not follow along with Evan's reporting, you can find him on LinkedIn, not on Twitter, as we talked about, but you can find him on LinkedIn. You can read him on Bloomberg Law. Terrific reporting that we rely on heavily here at Fintech Takes, and I know the industry does as well. Thank you, sir. We'll have you on again in the future.
And maybe we can talk more about Godzilla next time, because it's dear to my heart.
I think we have to. And not only that, but you had like 2 or 3 very well woven in movie quotes. I think we just need to do like a movie quote themed episode. So that is in the works. We will plan that. And until next time, sir, thank you.
Thank you.